Joining us now is Larry Shover. He's the Chief Investment Officer at SFG Alternatives in Chicago. Larry, thank you so much for joining us. Can we start by looking at the commodity space?
Sure.
Oil price on a bit of a tear at the moment. We're also talking about iron ore here in Australia. The results that we've seen overnight are quite extraordinary. What's going on? What's feeding this optimism?
Well, the oil market just perplexing to everybody because I would say just the opposite 24 hours ago from what I'd say today with regards to the report, the fundamentals. I think a lot of it from what I saw today was just a lot of short covering. We made 2-month lows yesterday for no real apparent reason. Product demand and the report that came out about a week ago was moderately bullish to the market. I have to say that oil continues to follow sentiment, not fundamentals. The report today obviously is a mixed bag, but it was a one-way freight train north today, just given a lot of short covering, a lot of risk on sentiment.
And why do you think this is coming through, though? It's interesting you say 24 hours ago you would have said the exact opposite. Now this change in momentum, is there a catalyst for all of this? What are we trying to make of it? What's behind this sentiment?
Yeah, it's a great question. I think, the market in general drew a lot of comfort from the jobs report that came out last Friday. And that was on top of really strong consumer spending, 2 blowout ISM numbers. A non-manufacturing number was the highest number we've seen in 8 months. So a lot of pent-up demand. Brexit has kind of gone away a little bit in the United States. The fear of the U.S. dollar, the fear of the oil price is kind of at bay. So a lot of pent-up momentum, people grasping for yield, and oil is part of that story. So I continue to look at the fundamentals of what's going on in the oil price and the products market, and it's illogical compared to the intraday trading. So looking at it will just make you scratch your head because it's just following sentiment and nothing else.
The bond market was interesting. This auction that's come through, seemingly less demand than you would have expected to come through, despite the yields looking relatively good compared to recent history. What's going on there? What's the story behind the action in bonds?
Oh, man, I think there's a lot of complacency in the bond market. When you consider in the U.S., the 10-year yield was 2.25% at the very beginning of the year. Even up to Brexit, we were trading at about 175 basis points. Last Friday, we were down to 137. Now we bounce up to near 1.5%. But all that to say is, what's it going to take for our bond market to or yields to go higher? You have 2 blowout ISM numbers, a good jobs report, consumer confidence, and we're reluctant to trade out of a range. It makes me a little bit nervous that we're content to follow JGB market. We're content to follow the Boone market. And I know to a large degree we have to just because of the carry trade, et cetera. You combine that with also the fact that outside investors still view the 10-year yield as a good investment relative to what they're getting in their country. So it's going to keep those rates down. But I do believe it would not take much for those yields to back up. And it's something people don't recognize. We could have inflation come out of nowhere, something we've been talking about for the past 18 months. And what's even more scary is that in the United States, we like to spend money and governments like to spend money. With yields this low, we could see an onslaught of physical spending, and that would dramatically change the bond market. So it's something that I am worried about, how overly complacent we are about low yields.
Larry, what's going to be a bigger issue, reporting season in the US or potential political uncertainty in, say, Italy and also the American presidential elections? What's going to weigh, do you think, on markets in the next few weeks?
Yeah, I think it's going to be the earnings season. There's a lot of assumptions being made. Right now, we're trading about 16.5 times earnings on a relative basis compared to bonds. I guess that's not too expensive, not too cheap. It's just right there. But we're assuming $130 for 2017. Not a whole lot of risk for error. So I think people are waiting and wondering what CEOs will say about Brexit, if it was just a one-off event, if top line revenues climb or at least have stayed steady from last quarter. That's the thing that's going to move the market. And I think that's one of the reasons why the market has made new highs. People just assuming given the numbers we had, that the second quarter earnings season is just going to be fine.
We've got Bank of England and Bank of Japan both looking like they are going to loosen the purse strings a little bit more quantitative easing going through. How much do you think this recent rally has been premised on looser monetary policy around global markets? And could that potentially disappoint if they don't come through with it?
Yeah, personally, I don't think that is the medicine that it used to be. In fact, I think it's the other way around. But it's been well telegraphed, well advertised that there's going to be dovish talk, dovish action, both in England and in Japan. So it's kind of priced into the market. I think, on the other hand, it's just not. The policy tools aren't as effective as they once were. So I think people want to see the world get out of this 5-year, 2.5% growth and get into escape velocity, and a dovish central bank just not going to accomplish that. So if it wasn't baked into the price already, I think it would be a headwind. But anything else additional from that, if we all of a sudden have the U.S. change courses, obviously that would be an enormous headwind to our market.
And Larry, we will be hearing from the big banks in the next little while. They're going to be peeling off pretty quickly. How much comment do you think they're going to give about the fallout from Brexit, about global instability, about potential more easing of policy? Do you think they're going to be quite forthcoming in their commentary?
I think they're going to have to. I think there's going to be a lot of pressure on them. You think like net interest margin is going to be okay. It's not going to be great. The one bright spot for the banking industry has been mortgages. There's been just a huge amount of refinancing that has helped them. But we know that fees have gone way down, especially in the M&A space, given some of the busted deals that we saw over the past 3 months. So beyond that, banks are in a bad way. They've been beat up royally. So I think it's in their best interest to communicate what Brexit has done and what they see going forward in the next quarter.
Larry, we'll have to leave it there. Thanks so much for your time.